Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. Interesting week with what we've seen in the market. The Dow fell over 1,000 points Monday and Tuesday as oil prices in the United States crashed. But today we're getting a bit of a relief rally.
Yes, and it seems to me whenever I look at the Bloomberg board of how the stock markets are doing, either everything is outlined in red one day and then everything is outlined in green the next day, meaning it's either been huge gains or huge losses. We're not seeing those calm days of like a gain of 50 points or down 50 points anymore, are we?
No, in fact, 3 years ago in 2017 and also in 2018, there was extremely low volatility in the financial markets until October 2019, or 2018, I mean. In fact, in 2017, the Dow didn't go up or down more than 1%, but 4 times the entire year. Now it seems like it does it every single day. So what's interesting about that is if you go back to see the other years when there was such super low volatility in the market, you really got to go back to 2006 and 100 years before that to the 19 teens. One year there was such low volatility. But big volatility like we're now seeing is really a characteristic of a market that's in a more bearish situation. The stock market averages, even though they're up today, they're still well off their 200-day moving averages. Now, in a bear market, when you get rallies back up to those 200-day moving averages, typically what happens is the bulk of the gains happen very quickly, in about a week's time, and then the market can spend weeks, if not several months, going sideways, no matter what the news is, even the news is bad or even if the news is good. So I really think that's what is setting up, just some sideways drift, for the probably the month of May, then we'll have to see, from there what happens.
How do you trade when you have a market like this?
Well, that's a good question. I'll tell you what most people do is they try to trade the rallies and jump. They try to do one or two things. They try to just buy the market averages when they're going up and they have up days with the expectation that this isn't a bear market, but the start, a pause that's going to lead to bigger and bigger gains to come, that we're really going to return back to normal, to the way things were a few months ago for the financial markets. And the story that people are believing in is that the economy is going to go back to normal, that we're going to open things back up, and the virus situation won't really be a big deal anymore. Some people think it's exaggerated. Some people think you shouldn't do anything about it, that it's just the flu. I think, honestly, though, this is pretty delusional, and that the virus, yes, things will open back up at some point this summer in stages, but it's not going to be completely open the way it was before all this started. And we may see a situation where there's some sort of tracking that we all become a part of through our phones. This is what's happening in some of the countries in Asia. They're if you catch the virus, they have your phone has an app on it that then marks you and then notifies anyone that you've been in contact for long enough and tells them to go into quarantine. And right now, Google and Apple, in conjunction with Facebook and some people in the Trump administration, are working on putting apps on everyone's phones that'd be on there automatically, that you'd go get a test, find out if you've had the virus or not, or if you have had it, that would be part of the information. So you'd be marked as someone low risk that has an immunity, and then going forward, you would probably need this to show people the status on your phone to go to sporting events, maybe even grocery stores or even some bars and restaurants. This isn't all completely planned, but they're working on it. And this seems to be, where things are heading, but, that raises a lot of questions of what it's going to be like. We're not going back to the way things were. We're going into a different situation when the current one of these lockdowns comes to an end. And I haven't been sick, personally with the virus. I don't think I've got it. I have no way to know, because I haven't been tested. But assuming I haven't had it, then I would be someone entering a world where if I go take a bus or ride an airplane and I have this app on my phone because I have to have it to be on an airplane, say, and if I'm unlucky to sit next to someone, that then gets sick, then I'll be marked and put into some quarantine situation. So that's going to make me think I don't really want to fly. I don't want to go to sporting events or do things where, it might become a giant hassle and I'll be locked in my house for 2 weeks. So, I'm saying all this to suggest that the economy is still going to face a lot of trouble from the coronavirus, even with all this talk that we're going to open it back up, we're going to do this, there's going to be a wonder drug. And, people are expecting a vaccine to come out in 16 or 18 months. But 16 or 18 months is still a long time from now. And, this is all going to have a negative impact on the economy. Not as big as one now, obviously, but there still will be one. And there still is going to be a lot of damage that's incurred from what is already happening at the moment. There are businesses going bankrupt, or they're going to decide not to open up. If I operated a restaurant, is there any way I could be certain of what my business will be like even when things reopen? So there's a lot of uncertainty out there. Nobody knows for sure how this is all going to play out. No one knows when a vaccine is going to happen, or even if one will happen. And if it doesn't, it's not the end of the world, because these viruses like this, they burn out in time, or they mutate into a weaker form, because what happens is the weaker forms tend to be the ones that are able to last longer because they don't kill their hosts, whereas the ones that are more deadly, they can die out with the people that they kill. So I think the virus situation will go away eventually, but not as quickly as people assume, who are buying stocks on the notion that this is a great buying opportunity, everything's going to boom again like it did last year or 2017 or something, and that's just not reality. In fact, I would suggest that what we saw in March was not simply a decline in the stock market, but more importantly, an implosion in the U.S. bond market, a financial crisis, in fact, akin to what happened in 2008. The Federal Reserve this time lowered rates to 0 in over 2 weeks and announced multiple QE programs. The one in 2008 was for $1 trillion. This time it's unlimited, and they're now doing tens of billions of dollars every single day. All this is being done in order to prop up the bond market, to keep interest rates low, because if the Fed wasn't doing this, there wouldn't be enough people to buy bonds to keep the rates as low as they are. And they wanted to prevent the decline that happened in March from turning into a complete financial collapse. So that's all serious stuff that happened, and there are weird things going on in the markets that tell us the situation is not normal. Just 3 weeks ago, the triple ETF JNUG for gold stocks completely blew up and crashed, and now it's no longer a triple ETF, it's a double ETF. It completely malfunctioned. Not because there's anything wrong with gold or mining stocks, but because triple ETFs are now in a heightened volatile market, instruments that can turn into chaos at any moment. And we saw it happen just yesterday. The double ETF for oil, USO, malfunctioned. It exploded and blew up, and now they're talking about they're going to have to stop that from being a 2 times ETF, make it perhaps a 1 times ETF, or do multiple reverse stock splits. It's a complete disaster. And the price of oil in the futures market went negative. So this is all telling us, yeah, the stock market is rallying. And look, I think it continue to hold up next month, maybe even longer. But these are not normal markets. And people who think that it's going to become a normal market this summer, I just think are completely delusional. That doesn't mean there aren't ways to make money, because there are things going up, making new highs, when the stock market is not. And that's what I'm focused on to make money now.
And Mike will chat about what could make money when we return.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Mike Swanson. Mike, what are some of the things that could be positive for you to invest in?
Well, I mean, the simplest thing, as we're doing this interview at this second, Newmont Mining, a gold company, the biggest gold company in the world, is trading at a 52-week high. I own that stock, but that's the most important gold mining stock because it tends to attract institutional interest. Like I said, it's the largest gold company in the world, but the GDX ETF is also trading at a new high this week, and the price of gold is back above 1,700. What is happening is while the U.S. stock market and almost every sector inside the stock market is below the 200-day moving average, gold and these mining stocks are above it. And basically, if you want to beat the market, you want to buy and trade the things that are beating the market. And right now, gold is really the only thing doing that. Now it's tough to buy Newmont, and some of these other big cap mining stocks when they're making new 52-week highs and they haven't really paused in a month. But the good thing about the gold complex is there's a lot of small cap exploration stocks, hundreds of them that trade in Canada, that they fell to in March, have come back, most of them almost 100% from the lows they made in March. But they're pausing, and a lot of them are lining up and think we'll do good and join the majors into nice moves for the rest of the year too. So that's the easiest thing to focus on. Now, ideally, I would want to put my money at work in multiple sectors for diversification purposes, but honestly, I don't really see anything at the moment going up. I mean, at some point there will be opportunities to buy other things, and I want to be a part of them. I mean, oil has crashed this week after falling for several weeks. And energy stocks are something I would like to invest in at some point when I think they're starting a new bull market. But when something falls like this, typically it can take 12 months before it can rally through the 200-day moving average and begin a new bull market. So in my way of thinking, oil and energy stocks are probably like where gold and the mining stocks were in, let's say, in 2016 or so, or 2015 in the summer when they made their ultimate low, but then they spent several rest of that year building a base. So I think energy needs to build a base, and other commodities too should do the same thing, and I think there'll be great opportunities in them next year, because ultimately all this money printing that the Fed is doing is going to end up creating a lot of inflation. It's not now. We're in the sort of the deflationary cycle of a complete demand collapse in the U.S. economy. One reason oil fell is that the usage of gasoline is down by a third in the United States. The usage of electrical power is down 8% across the entire country. The numbers are incredible when you dig into what is actually going on. So the people who think there is opportunity when things come back on with the economy, I think they are correct, but I think they're not correct in thinking it's just going to be this incredible boom and I just throw my money in the stock market. You got to really figure out what doesn't require a boom to go up and what can just go up almost by itself when it does bottom out.
Mike, companies that engaged in major stock buybacks, buying back billions of dollars in stock, should they be bailed out now because they didn't save that money for a rainy day?
Well, I mean, I would like to say no. That, for example, the airline stocks, they engaged in massive buybacks, so now they're, at the front of the bailout programs. But and another example is how crazy it all is Norwegian cruise lines. They did all these bailouts for years, then the stock crashed, and they had to do a raise by selling stock at basically the prices way below what they were buying them at. So the buybacks have been a complete mess. The only problem with me saying I wish they wouldn't give these guys bailouts is almost all of corporate America did it. So there would probably be no bailouts at all if they decided not to bail out companies that did buybacks. But I don't think they'll be doing buybacks anymore because they can't afford them.
Should buybacks be made illegal again?
Well, I don't think it, in one sense, I don't think it matters because I don't think they're going to be able to do them because what's happening in the economy and their balance sheets are destroyed. So many of these companies. However, I wouldn't mind it if they were just made illegal because I don't believe they provide any function for the economy and even for shareholders. I mean, yes, they make stock prices, or they did, make stock prices go up, but they don't really improve the fundamentals of these businesses. They don't grow revenue. They don't help invest in technologies or anything. So I think this is kind of a waste of money. And yeah, this kind of shows the end result. It's okay when they're going up, but they don't go up forever. And then all the money was blown and wasted away. So illegal, it would be nice if they were, but they're definitely stupid to do.
We'll have more with Mike Swanson right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's the benefit of super low interest rates, 0%, or in Canada, the Bank of Canada, 0.25%? Because the banks are not lending money at those low rates.
Well, I don't think I think the way to put it is not that there's really a great benefit to the economy. I would also say the same thing about the stimulus programs that the U.S. is passing in other countries. I'm not aware of what's happening on that front in Canada, but these programs and the low rates, I don't think they stimulate the economy or are going to grow the economy. Instead, I think what they are really doing is keeping the economy alive and keeping it from going into complete collapse. So let's say in the United States, if someone is unemployed and they're getting a $1,600 check from the government, well, that's going to enable them to buy food so they won't starve to death. And that's a metaphor for, I think, all these programs. It's just to keep things alive, but it's not going to grow anything. And as far as the interest rates, it's the same story. So the biggest problem with the interest rates and why they are zero is that what has essentially happened is there has been a massive corporate bond bubble in the United States and in Canada too, but the United States is the leader of it in the entire world, where companies have issued junk bonds at super low rates and have indebted themselves. And over the years, they've used the money for stock share buybacks to force the stocks up. That benefited people in the stock market, so people really liked them because they thought it was making them money. And at the same time, the U.S. government is now going to have a debt to GDP surpassing what it had during World War II because of the explosion in the trade deficits, the government funding deficits, and all these stimulus programs. What that does, though, is it makes the interest rate really critical for what it costs for the U.S. government and for corporate America to finance these debts that they've accumulated. So if rates were to go up, they would not be able to fund, the government won't be able to fund the debt. It would default. So as a result, the Fed has made rates zero and is buying treasury bonds itself in order to prevent the U.S. government from defaulting. And the corporations are sort of benefiting the same way. The Fed, in fact, has announced that it's going to buy corporate bonds. And not only corporate bonds, but pure junk bonds, something that no central bank in history has ever done. This will do absolutely nothing to stimulate the economy, but it will enable these companies not to go bankrupt. So that's what all these programs are about, just preventing total collapse, preventing defaults on debts. But there will be an eventual cost, and that, I believe, will probably begin next year when the economy does bottom out, when, let's say, the price of oil turns around for good. It can bounce up and down. Maybe it bottomed. I don't know. But the real sustainable move in oil, when it happens in other commodities, will signal that this downturn in the economy is over, but that next upturn, I think, is going to be associated with a lot of inflation. And that's going to be the ultimate cost of keeping things alive. which is what all these programs are doing. It's also why gold, I believe, is going up now first and is asserting leadership in the financial markets. Gold is now acting as a safe haven. There are high net worth investors, institutional investors. They don't think of mining stocks or gold as something to play or trade. They don't buy things like JNUG. These type of people, though, see that the bond market provides no value from an investment standpoint when rates are this low. And what it does provide is incredible risks, because when the day comes that inflation comes, bonds bought today at these low rates will go down in value. So as an alternative to just putting the money in the stock market or in cash, high net worth investors, institutional investors are putting some to work in gold to protect what they have. So it's not simply just a trade to make money, although it is. It's now providing a real diversification function in the markets, and I think it's important for people to understand that, to know what's happening in the big picture. And it's not really explained that much on the television, where the narrative is just buy the stock market and bet on everything opening back up, and nothing beyond that is really told to people. And it's just, because frankly, in the United States, most people aren't making changes in their accounts. They rode everything down. They didn't sell. It's bouncing back up, and they don't want to do anything. They're kind of trapped. They're grasping on to predictions it's just going to go higher, or they hear other predictions that it won't, and they don't know what to do. So that's one reason things are going sideways, and probably will continue to do so, is people don't know what to do, and they are scared to make a decision. And when people are like that in the markets, ultimately what ends up happening is the market itself forces them to make a decision by going low enough that they can't take the pain anymore, and then they liquidate. Or it just goes up so high that they feel like they can't miss out anymore. That's what creates bull market tops. But I think that top already came, months ago. And if you go back to earlier this year, in January and February, as we were making that top, almost every person out there that comments on the markets, and I'm including myself when I say this, became bullish on the stock market. I don't know of a single person who was warning. Maybe you had a few on your show because you have some exceptional guests, but personally, I don't know of anyone in January, February who was warning of a drop or a bear market coming this year. The consensus became this can last until the election, and maybe next year there'll be the bear market. That's what the people that were bearish last year were then saying. So everyone got bullish, and then the market fell. And in a normal cycle, we would be thinking about that, but because this virus situation has happened, as the market fell, and they're linked together, kind of the normal cycles aren't being thought of by people, and the virus is kind of, at some point, I think, is almost going to be used as an excuse to explain everything that's going on, when there was a virus in 1918, the Spanish flu virus, and it lasted for a year and a half, but the Dow went up like 30%. So viruses in themselves don't necessarily mean the stock market has to go down. So people, I think, need to look at the charts and think about where we are in these cycles and try to match their trading or investment strategy in accordance with that, and not just headlines about the virus or, predictions out there that people are throwing around.
Mike, thank you so much for chatting with us.
Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.